It's Tuesday, February 18. Welcome to Business Morning. I'm Chimeze Obi Iwago.
Good morning. And I am BC Adebayo.
Well, the National Bureau of Statistics has just released the inflation numbers for January and is reporting a 12.13% rise in the month under review in line with analysts' expectations. Now, increases were recorded in all divisions that yielded the headline index. On the month-on-month basis, the headline index increased by 0.87% in January 2020. This is 0.02% rate higher than the rate recorded in December 2019. The percentage change in the average composite CPI for the 12 months period ending January 2020 over the average of the CPI for the previous 12 months period was 11.46%, showing 0.06% point from 11.40% recorded in December 2019. The urban inflation rate increased by 12.78% year-on-year in January 2020 from 12.62% recorded in December 2019, while the rural inflation rate increased by 11.54% in January 2020 from 11.41% in December 2019. On a month-on-month basis, the urban index rose by 0.92% in January 2020, up by 0.02% from 0.90% recorded in December 2019, while the rural index also rose by 0.83% in January 2020, up by 0.01% from the rate recorded in December 2019.
Well, there's more. The composite food index rose by 14.85% in January 2020, and that's compared to 14.67% in December 2019. Now, that rise in the food index was caused by increases in the prices of bread and cereals, meats, oils and fats, potatoes, yam, and other tubers and fish. On a month-on-month basis, though, the food sub-index increased by 0.99% in January 2020, and that's up by 0.02% from 0.97% that we saw in December 2019. Now, the average annual rate of change for the food sub-index for the 12-month period ending January 2020 over the previous 12-month average was 13.86%. Of course, that was 0.12% from the average annual rate of change recorded in December. And all items less farm produce or core inflation, and that excludes the prices of volatile agricultural produce, stood at 9.35% in January, and that's up 0.02% compared to December 2019. And on a month-to-month basis, the core sub-index increased by 0.82% in January, and that was up 0.01% compared to what we saw in December. The highest increases were recorded in prices of hospital services, vehicle spare parts, cleaning, repair, and hire of clothing, shoes, and other footwear, glassware, tableware, and household utensil, hairdressing salons, and personal grooming establishments, repair and hire of footwear, garments, and passenger transport by air.
All right, turning away from the inflation numbers for a moment, Bua Cement, Zenith Bank, and GT Bank were the major culprits yesterday that dragged the market further down. BC, you have the numbers, right?
Absolutely, Chimeze. Now, we saw bearish sentiments continuing to drag the Nigerian equities market further lower on Monday. Now, we saw the all-share index down 0.67% to 25,570.9. And that followed the investors' sell-offs of Bua Cement, just like Jimmy mentioned, Zenith Bank and Guarantee stocks. But the month-to-date loss increased to 4.4%, and the year-to-date gain moderated to 2.7%. Total volume of trades increased by 23.8% to 134.61 million units, and that was valued at 1.58 billion naira, exchanged in 3,302 deals. All the sector indices closed negative except the oil and gas index, and that was, of course, driven by an increase in the share prices of Owando and Depol. All the others remained unchanged. And at the NASD OTC market, now, there wasn't so much of activity on Monday. Now, the index was down 0.03%, and the market's capitalization was seen at 501.59 billion naira. Volume was in at 20,053, valued at 2.58 million naira in 5 deals. And to the fixed income space now, the Treasury bonds market sustained its bullish stance as average yield contracted by 3 basis points to 10.1%. Of course, there was more activity in the long end of the curve, talking about July 2034, and in all we saw 24 deals valued at 8.54 billion naira. And at the NTB Security of Secondary Markets, it was bullish as the average yield paired at 2 basis points to 3.8%. Of course, we saw yields contract at the mid-segment following buying interest in the 150 date to maturity instrument. And on the flip side, the short and long end of the curve traded flat. 13 deals were recorded with an 8.02 billion naira value. And elsewhere, the average yield contracted by 25 basis points to 13.0% in the almost secondary market. Now, 378 deals were exchanged and valued at 130.78 billion naira. Well, we hope that the markets get better today, particularly at the Nigerian equities markets, Jimmy.
Well, let's hope so. But, you know, we're yet to see some kind of positive catalyst that can actually move market sentiment there. Well, let's take a moment and we'll be back with the commodities market update. Do stay with us. Well, inflation numbers, that's the hot topic on commodities market today. Temitope Olubile, one of the research analysts with Financial Derivatives Company, joins us now. Good morning, Temitope. Good to see you.
Good morning. Thank you.
Well, I guess it's all ladies' thing.
Right.
All right. Oh, we saw the January inflation rate, 12.13%.
Yes.
You projected 12.05%.
Yes, we did.
Well, that's in line with your projection.
Yes,
What
it is.
factors did you see driving the inflation numbers?
Okay, yeah, so like you rightly said, there was no surprise as to the increase in inflation. It was well expected. I mean, the shocking thing was, you know, month on month, for the first time in a while, it actually moved in line with headline inflation. We still see that, you know, the supply shortages, because if you take a breakdown of the inflation numbers, you see that food inflation remained the main culprit. It recorded the highest percentage change of all the sub-indices. So that still plays into the supply shortages coming from the border closure. I mean, yes, there's been an increased production since the border closure. It's not as shocking as it was when it was just closed, but it still plays an impact in inflation numbers, and that's what we are seeing, and that's what happened for the January inflation.
Now, of course, Tokwe, Nigeria's inflation remains high at a time when sub-Saharan Africa's inflation is flat. Now,
Yes.
what exactly does this say of the central bank's inflation targeting strategy?
Okay, so yes, I mean, the central bank, the MPC, the main assignment remains price stability, right? I think they're doing okay. I would say they're doing okay because you take some extraordinary events like, you know, the border closure. They now have to find a way to still curb inflation given, and that's what they tried to do at their January meeting where they, you know, they foresaw the impact of increased Naira liquidity on what it would do with demand. So that's why they increased their CRL, you know, hike. That's why there was a hike in the CRL. So that is, and with the next meeting in March, they should still keep their eye on inflation because these inflation numbers does not even take into account the VAT hike that kick-started on February 1st. It doesn't take into account the upcoming electricity hike that should take effect from like April. So they need to definitely keep their eyes on inflation.
So does that mean there's possibility there might, they might possibly, you know, think about tightening or?
I mean, I would say that it still remains on the table. It's not completely off. It's given what inflation trend is doing. So definitely a possibility of a tight monetary cycle is definitely on the works. And it's on the table. It's something they would be considering, I would say. But if they would do it, I can't speak to that yet.
Now, still talking about the numbers. Now, looking at the food index, it remains high. How worrying is this situation?
I mean, it's something that it should worry the Nigerian consumer because, like I said, this inflation is not as bad as it could get when we start to see the impact on VAT hike and electricity tariffs. But I think that with, the supply shortages, we've seen some increased production because with the border closure, they have cut off the small goods supply, the small good competition. And so there has been more incentives for, farmers to increase their production. But now the willingness, is it accompanied with an ability to actually increase to what can meet supply? Because yes, they are more willing because competition is cut off for now, but we need to also increase their ability. So that's speaking to the infrastructure gap. But I think that we're on the right path to increasing the production of many of our staple goods in Nigeria.
If you say we're in the right path, now what is your outlook for inflation trajectory in the near to medium term?
Definitely, it's going to keep increasing. I could say that that's at least a 90% probability of an increase of the trend to continue increasing in the coming months. So yes, that's definitely what would happen. I mean, VAT hike, electricity tariffs, like I've said, that is definitely going to have an impact. And if you look at other factors like the naira liquidity, which the CBN has tried to, take care of, but it still remains given the maturing OMO bills, we're expecting it to pick up in February. That is still definitely one of the things that would impact on inflation.
All right. Looking at your burning economic issues, of course, this morning the IMF has just cut its growth forecast for Nigeria from 2.5% to 2%.
Yes.
What does that tell us?
Okay, so I mean that is a significant revision, downward revision, sadly, and that speaks to, if you read the report, it's basically a reflection of the impacts that the fall in oil prices could have on Nigeria. If you flash back to 2016, that's when we went into a recession, right? So it just shows that we are still vulnerable to oil price shocks. And the thing about oil is that you can try to, project what oil will come at, but then when you have extraordinary events like the coronavirus, you have to be able to build your resilience to such shocks, right? So that's why the IMF, and, they also mentioned other challenges like, the external challenges, which oil prices, falling external reserves. Now we have also fiscal challenges like a weak non-oil revenue, which the government is trying to take care of by increasing VAT to try and boost our tax revenue. But there are those challenges. And so that's why the IMF is recommending policy reforms that, just build your resilience such that you're not so vulnerable to oil price shocks, because things happen. If you recall Saudi Arabia's attack on its oil facilities, that was not planned for. Extraordinary events happen that you need to be.
And Nigeria does not have control over what happens on the international market.
Yeah? Do you understand? We can't control these things, but what we can control is our resilience to these shocks.
And still talking about controlling resilience to these shocks. Now, the consistent decline in reserves, I mean, we've seen the reserves decline consistently. What can you say about the CBN's capacity to keep defending the currency peg?
That also speaks to one of the burning issues about how African countries are having undervalued currencies, but Nigeria and Ethiopia, they are still keeping their currency strong. I think the thing about this thing is an undervalued currency. Yes, there's been increased research to show that it's actually good, but for Nigeria, the thing about it is it has to be strategic. It can't be, because we're still import dependent,
yeah.
Because we have imported capital, imported goods, and if we say that, okay, fine, we want to show the true value of the naira, it could have some major implications on consumers. While it will have good in the long term, what about the short term? Do you understand? So I think the CBN, yes, is still trying its best to keep the naira strong, and with good reason, obviously, because you don't want.
And who knows for how long that will last?
I mean,
anyway,
time.
Yeah, we were talking about a possibility in tightening, and then of course it's one of the recommendations by the IMF that perhaps the central bank might begin to think of further tightening of the monetary policy. What would be the implication of this, and what kind of tightening do you think the Monetary Policy Committee might decide to take?
Okay, so for the tightening for the IMF and for us at home, the immediate impact on that is, inflation, because you see inflation rising and you're like, central bank, should be tightening to curb this inflation because that is their primary assignment, right? But, the question you asked about what kind of tightening, they have all kinds of tools available to them. That's why the last time they used the CRL tool, with this next month meeting, we can have that they will be using the MPR tool. They could go back to the MPR tool. There are other tools available to them. Now, the immediate impact is to curb inflation, which is, by and large good. But, what about the impact on lending, which is what they seem to be really focusing on and trying to drive increased lending to the private sector to, boost growth. And so by their next meeting, they will have the Q4 GDP numbers, which is scheduled to be released next week. They will see the trend of inflation, and they will take all of this into consideration as to which one to focus more on. That's what I think they would do.
But what if it comes to a point where the Naira is actually devalued? What will be the implication, especially regarding the domestic commodities markets?
So a devalued Naira would mean that, your exports are cheaper, but your imports are more expensive, right? But because Nigeria is still import dependent, I really fear for what that would mean on inflation, because you have your imported inflation spike, and we already see that inflation is on an increasing trajectory. So the immediate fear for consumers and for even investors, as far as investors want, the true value of the Naira to be revealed, that's what they want. The consumers are worried about what that will mean for inflation, and that's pure economic sense. You devalue your Naira in a time of increasing inflation. I really fear for the pockets, disposable income of consumers.
All right, let's quickly take a look at the commodity in focus, and we're looking at milk.
Yes.
This milk thing has actually been in the news for a while. Anyway, where is Nigeria in terms of milk production now, when we are having companies being restricted from having access to foreign exchange?
So that really is what informed the choice of the commodity in focus, because of the news we got last week about, the CBN, restricting some companies from forex, but, giving access to some. I think milk is a very interesting commodity for Nigeria, because we have we're one of the largest producers of livestock, but yet our milk, we're one of the huge importer of, processed milk. And this is because our cows only produce 1.5-2 liters of milk compared to our consumption of 8 liters. So our cows need to improve the productivity, the milk productivity of our cows. There's some things that we need to do, like the way we keep them, the animal husbandry system, what we feed them. Those are the things that would improve and boost their milk production. So yes, while you want companies to do backward integration, go instead of importing milk, it's not just compelling them to do the backward integration. What are we doing for these cows to actually produce the milk, right? So that's why we did this.
I think that would be a good point to leave this conversation. Temitope, thanks for coming on the program. Temitope Olubile is a research analyst at the Financial Derivatives Company. We'll take a moment now, and when we return, we continue to track the vulnerability indicators of the FX market. Do stay with us.